Welcome back to the Deep Dive. Today, we're cracking open the financial reports of CarTrade Tech Ltd. We're taking a close look at their unaudited results for Q2 and the first half ending September 30, 2025. That's Q2 and H1 for FY26. And the headline they're using is unavoidable, best ever performance. But, for us, that's just the start, our mission today. Figure out what's really driving this success.
Yeah.
How does this kind of integrated marketplace manage, 29% revenue growth, which is healthy, but then turn around and explode profit by 109%. That difference, that's the core thing we need to unpack.
It really is an incredible set of numbers, and it changes how you think about scale and efficiency in this whole auto marketplace sector. Looking at the consolidated Q2 results, the main figures are striking. Revenue hit 222.14 crores. Now, for listeners maybe not familiar, a crore is 10 million rupees, so yeah, serious scale.
Right.
That 29% year-on-year growth, very solid.
Okay.
But you nailed the critical point. Profitability, profit after tax, or PPA, jumped to 64.08 crores. That 109% UY increase. That's where we need to focus.
It's exactly.
Because when profit grows nearly 4 times faster than revenue, you're seeing, pure operational leverage at work.
And the clearest sign of that efficiency has to be the margin, right? The consolidated EBITDA margin shot up to 33% in Q2.
Yeah.
That's up from 21% the year before. That's a huge leap, 12 points.
Yeah.
It feels like going from a normal car engine to a jet engine almost overnight. What makes a 33% EBITDA margin so significant for this kind of business?
Well, it signals a really mature business model. A huge chunk of every new rupee of revenue is dropping straight to the bottom line. We're not talking about some startup burning cash just to grab market share. This looks like a market leader with real pricing power and tight cost control.
Okay.
And it doesn't look like a one-off either. If we just quickly look at the half-year results, H1 FY26, the momentum's there. Revenue grew 28% YoY to 420.64 crores.
Right, it's consistent.
And PAT was 111.14 crores, still maintaining that triple-digit profit growth, up 107% YoY. So the model seems stable, repeatable.
Okay, let's get into the engine behind this efficiency. Starting with traffic quality. Their total reach is massive. CarWale, BikeWale, CarTrade, OLX India. It's around 85 million average monthly unique visitors. Huge user base.
Staggering numbers, yeah.
Now, here's where it gets really interesting for that profitability story. The reports say an amazing 95% of this traffic is organic. So for you listening, what does that actually mean? Running a huge digital platform almost entirely on organic traffic.
It means they've built a massive competitive advantage, a moat, really.
Right.
When 95% of your 85 million visitors find you directly or through search or just know the brand, and you didn't pay Google or Meta for that click, you've basically disconnected your growth from your marketing budget.
Oh, okay.
That's the first huge piece of this operational leverage puzzle.
So less spending to get customers in the door.
Exactly. Think about it. Normally, if you want, say, 29% more sales, you need more salespeople, more stores, maybe crank up the ad budget by 20, 30%.
Yeah, sure. Makes sense.
But for a tech platform running on 95% organic, they can handle 29% more revenue with just tiny increases in fixed cost tech, maybe some staff. They aren't paying to acquire that next user. The user is just showing up.
That makes perfect sense. Growing the top line without growing costs at the same rate, that's efficiency defined. But we keep saying operational leverage. Can we just drill down on that for a second? Especially seeing PAT grow 109% versus 29% revenue growth.
Absolutely. Operational leverage. It's like magic, really. It happens when your fixed costs are high. Think data centers, core engineers, the basic infrastructure that costs roughly the same whether you serve 1 million or 10 million users.
Right, the foundation.
But once those fixed costs are covered, each new dollar of revenue costs very, very little to bring in.
Okay.
Imagine building a superhighway. That's your big fixed cost. Once it's built, adding more cars, that's revenue costs almost nothing extra, maybe a bit of maintenance, the variable cost. In CarTrade's case, the high organic traffic means their tolls are effectively zero. So when that 29% revenue increase happens, most of it just bypasses the variable costs and flows straight to profit. Hence, the 109% PIT surge.
That's superhighway with zero tolls analogy.
Yeah.
Yeah, that really clarifies it. Okay, so high digital efficiency. But this has to connect to the real world, right? Especially with something like used cars, high value, high trust needed. How do the sources show that connection between digital efficiency and physical scale?
That's the other absolutely crucial part of their model. They didn't just build a digital giant. They also simultaneously built out their physical footprint across India. That ensures the last mile delivery and, importantly, trust.
Okay.
The company now has over 500 physical locations. That includes Shriram Automall, CarWale I'm Sure dealers, Signature dealers, and the OLX India outlets too.
So if the 95% organic traffic is the moat-keeping competitor costs high,
Yeah,
then the 500-plus physical spots are like trust anchors needed for the actual transaction.
precisely. Selling used cars always involves overcoming a trust gap, doesn't it?
It does?
The digital side brings the massive volume and efficiency,
Mm-hmm.
but you need the physical presence for inspections, verification, financing, running the auctions.
Got it.
They're using that low-cost digital funnel to feed a high-trust physical network. It's the synergy between digital reach and physical touchpoints that really unlocks that overall 33% consolidated EBITDA margin.
That explains the big picture numbers, but the sources also say all three main business areas hit their own records. So let's shift focus now and look at what makes each segment tick, because they seem to have slightly different profit drivers.
Good idea. They do operate differently.
Let's start with segment one, the consumer group. This looks like their high profitability engine. Q2 revenue was up a very strong 37% year on year, and PAT grew 82% YoY. Still huge profit growth, but the margin here is the standout metric.
Yeah, what really jumps out is that the consumer group hit a 40% EBITDA margin in Q2. That's an industry benchmark.
40%? Wow.
This segment is the pure digital play listings, advertising revenue, all coming from that huge organic traffic base. Hitting a 40% margin while also delivering 37% revenue growth. That shows real mastery of platform economics.
What does 40% signify in that context?
Well, 40% is often seen as the ceiling for even the world's most successful software or platform businesses. Getting there suggests they've really optimized everything, ad inventory, pricing, overheads to near perfection. They're basically squeezing maximum value from every single one of those 85 million monthly visitors.
Okay, let's move to segment two. OLX India. Now, this is the integration story, right? And where we saw that absolutely dramatic profit jump. Q2 revenue growth was solid, 17% YoY.
Solid, yeah.
But I have to wonder, acquisitions can be really tough to integrate. You often see cost overruns, maybe performance dips temporarily. OLX was a big one.
Yeah.
Did the sources give any hint about how they turned 17% revenue growth into that profit explosion?
That's probably the deepest insight in this whole report, actually. The execution on the OLX integration looks like a massive success. Revenue up 17%, sure, but profit after tax grew a colossal 213% year on year.
213%.
Yes. The sources specifically mention realizing operating leverage and synergies.
Okay, so what does that likely mean in practice?
We can infer it means pretty aggressive cost cutting, probably merging duplicated functions, think tech stacks, marketing teams, admin support. They likely rationalize quite a bit.
Right, shedding the overlap.
Exactly. And look at the EBITDA margin for the OLX segment. It went from a respectable 18% last year to 30% this quarter.
Wow, another huge jump, 12 points again.
That huge shift, 12 points in 1 year, tells you they likely shut down redundant systems fast and pushed the acquired OLS volume through their existing, highly efficient, low-cost platform. They didn't just buy it, they surgically integrated it into their high-leverage engine.
That 213% PAT growth really highlights the payoff from successful integration in this kind of model, doesn't it? It shows that integration risks, while definitely real,
Oh, absolutely.
can yield huge returns if you nail the execution.
It creates this powerful flywheel effect. You use the acquisition to boost market share and network effects. Then you apply your superior efficiency, that 95% organic core, to handle the new volume at a much higher margin than the acquired asset could manage on its own.
Makes sense. Okay, finally, segment three, the remarketing business. This seems to be the stable volume player. Less about those explosive profit jumps, maybe more about scale and consistency. Q2 delivered 23% revenue growth and 30% PPT growth YoY.
That's right. This segment is really the backbone that moves the physical inventory. It ensures that high-volume transaction flow. The margins aren't 40% like the pure digital side, obviously, but they're solid. And the key operational metric here is telling. The remarketing business hit an annualized run rate of 1.8 million listings for auction in Q2.
1.8 million annualized.
Right.
That's a lot of vehicles.
It's a staggering number going through their system. That scale cements their position as the dominant vehicle auction platform. And that, in turn, feeds inventory and transaction data back into their digital platforms, which strengthens the whole ecosystem loop.
Right.
This stability also makes them less vulnerable to, say, ups and downs in the digital advertising market.
Absolutely. So the overall strength comes from that balance. High margin, digital, successful M&A integration, and robust high volume remarketing. Okay, let's pull back again to overall financial health. This provides really important context for how sustainable all this is. The sources keep highlighting that the company remains entirely debt-free.
Yes, completely debt-free, and alongside that, they have very strong liquidity. They're sitting on a substantial cash balance, around a 980 crores INR.
That combination is interesting. Zero debt, huge cash pile, and triple-digit profit growth.
It paints a specific picture of financial conservatism combined with high operational growth, doesn't it?
It does. Though I wonder, is that much cash maybe too conservative? If Pass is growing 109% and they have no debt, why not deploy that capital faster? Maybe expand into related services or acquire more aggressively outside the region.
That's a great strategic question. While the market often cheers for rapid capital deployment, having that much cash provides a really strong defense against any market shocks.
Yeah.
And it gives them ultimate flexibility, meaning any future strategic move, another acquisition, maybe a share buyback, a big internal investment, they can fund it instantly.
Right.
No need to go cap in hand to external funders, which minimizes dilution risk for existing shareholders. It really underlines the sustainable part of their growth story.
Okay, so let's synthesize all this. We started with that paradox, 109% profit growth on 29% revenue growth. What does it all mean together?
Well, the puzzle pieces seem to fit quite neatly. The chairman, Mr. Vinay Sanghi, sums it up as strength from a diversified digital ecosystem focused on operational excellence.
Yeah.
But the mechanism seems clear. They built this incredibly efficient digital funnel. The 95% organic traffic that costs almost nothing to run at scale. They run high margin services through that funnel, and they use that core efficiency to rapidly absorb and scale up acquisitions like OLX, achieving, well, extreme operating leverage right across the business.
So, recapping the core takeaway from this deep dive into the Q2 FY26 results, it looks like a highly effective strategy. Drive high-quality, high-margin revenue from digital, underlined by that amazing 95% organic traffic,
Yeah.
while also leveraging that integrated physical network of 500-plus locations to handle the high-volume, high-trust transactions needed to actually close the deals.
Which brings us back to that central analytical question for you, the listener. Profit growth at 109% PAT jump absolutely dwarfed the 29% revenue growth. Yeah. So it raises a really important question. When you're assessing the long-term value of these kinds of integrated digital ecosystems, should your focus be more on margin expansion and penalty growth, the stuff driven by operating leverage and synergy execution, or just the raw top-line revenue number? What does sustained triple-digit profit growth really imply about the long-term compounding potential of a business like this, integrated, debt-free, and clearly having cracked the code on scaling efficiently?
That is a powerful thought to consider as you look at other platform businesses out there. Thank you for joining us on this deep dive into the mechanics of profitable growth. We'll catch you next time.